Good afternoon, friends. So this morning, I was just responding to some friends who were talking about different different charts that they're looking at, different shares that they're holding, different underlyings that they're holding, and basically everything is down and down and down. And so there was this advice going back and forth that, just average down, just average down. And I think that there is a really significant confusion between dollar cost averaging and averaging down. Dollar cost averaging is actually a strategy that licensed financial advisors, people who have a legal obligation to their investors, they use dollar cost averaging. And what that is that they have a methodology, whatever that may be, whether it's using EMAs, whether it's using support and resistance areas, whether it's using the volume profile. And so as an underlying is expanding in its value and the sector continues to do well, they will continue to put funds into those underlyings or ETFs or sectors while the underlying is expanding. So they're actually dollar cost averaging into a growing bullish area. And then as they start to see some of their, whatever they've built their thesis on, whatever the hedge fund or the institutional investor, whatever their methodology is, when the underlying is no longer performing to the right standards and they feel that there is subperformance in a certain sector and underlying, then what they do is they start having tighter stop losses to avoid accounts having significant drawdowns. Now, I'm not sure when this started or why this started, but suddenly then dollar cost averaging and averaging down started to mean the same thing. And that is not accurate at all. So if somebody was an institutional investor and they actually had a legal obligation to the person that they were advising, they would not be allowed to say to them, average down. Because essentially what you are doing is that you are actually throwing good money after bad, because now you realize the thesis of your underlying has potentially changed, whether it's because we're in a bear secular market or a bear cyclical market for that particular underlying or sector, and you are continuing to average down in a sector that is continuing to drop and hasn't yet found its bottom. And so it defeats the purpose entirely of having a stop loss and having trade management and risk management rules. Now, in this current market, there are a lot of sectors that are doing very poorly because they do not respond well to a high inflationary environment. However, there are areas that are doing very well and will likely continue to do well because we are in a high inflationary environment, because there continues to be inflation, because there continues to be a supply issue relating to oil and natural gas and crude oil and so forth. And there are supply chain issues that are affecting certain areas and are not affecting other areas. And so, what we need to do is become stronger at our sectoral analysis so that what we are looking for is when sectors are rotating out of bullish activity, getting into those sectors that are. And part of the reason is because, as a lot of people are finding, is that even when you think to yourself, well, all I'm going to do is day trade puts or day trade shorts, is that oftentimes you can get chopped up. Because the reality is that overall, we don't know what all the different portfolio managers and all the different level institutions, what their diversification rules may be. So even though an area of the market might not be doing very strong, they may not be able to completely pull out of that sector, which continues to give us what we call those bear flags. When there has been an overselling of a market, suddenly we start to see kind of a pump up, a slight bullish action in a bear market situation. And so then we end, as retail investors that are probably trading are unable to trade consistently with quarterly contracts, start getting chopped up. And that's how we start losing money. So, be advised that if you want to dollar cost average, the concept or the idea came from institutional investors that had rules relating to putting more money into sectors that were outperforming. And that's how they were actually able to beat the S&P, because the S&P is only holding a certain number of sectors, mostly XLK, well, tech, consumer discretionary, communications, industrials, energy, and financials. Those are mostly what the S&P is holding. So if you want to outperform the S&P, then you need to have a composite in your own portfolio that is leaning towards those bullish areas. Because as you see, something like oil, people are like, oh, it's already having parabolic moves. But if you get in where it's having pullbacks, while the environment is still, the financial environment is still high inflationary, there's still demand in oil and gas, why is XLE suddenly not going to perform for the next 2 or 3 months as we approach, remember, the global south will be now entering their winter period. So they will need oil and gas, quite significantly, even if maybe those of us living in the global north aren't facing those same winter feelings. And we're now, in spring and have warmer weathers. So the reality is, like I said, is that be careful, guys, about dollar cost averaging as underlyings are going down, because we don't know where the bottom is. The other thing is that the way that innovation and technology are moving so rapidly, it is difficult to know if some of these companies will even be around 5-10 years from now. So those old philosophies about buy and hold for 10 years, I mean, if we look back even 3 or 4 years, some of the companies that are performing very well at this particular moment were hardly even known by the public 3 or 4 or 5 years ago because of how fast technology and innovation are moving. So just be sure that you don't get on the wrong side of the move of some of these underlyings if you are dollar cost averaging, but actually you are averaging down before you see a bottom. Now, if you have any other questions or if something wasn't clear, feel free to reach out to me, because I do think that this is a very important topic. And I think that it's essential, if we are going to close the wealth gap, to make sure that we are not all encouraging each other to invest in stocks long-term, which might not have a very long-term thesis. They might not be around in their current state 5 years from now. And if we're all pouring our dollars and cents into a few companies that might not be able to perform at their 2021 highs, then there are some people that doesn't matter how much they average down, they're never going to break even. And so we don't want to discourage people from getting into areas of the market that are performing well. And most of those areas are not technology. So, we just have to be really encouraging one another to get in where the market is hot and not to pour all of our money into averaging down on positions that aren't performing well. The other thing is we can use options to income generate against our long holds. So if you are holding shares in underlyings that aren't necessarily performing very well, then I would encourage you, learn how to sell covered calls, learn how to sell short puts if something is moving in a price corridor, or learn to sell strangles, because that will also help you income generate against low performing stocks that you have in your portfolio, and allow you to take that income and reinvest it into new areas that you might not have invested in before, like energy or commodities, that will allow you to redirect those funds into areas that are performing, so that you're constantly diversifying your portfolio in areas that have strong performance, even if you want to hold on to your shares where there is lower performance. And that way you're not just spending all of your money in averaging down, but you're actually spending your money to diversify where there is bullish activity. Now, if you want to learn how to sell covered calls, short puts, or sell strangles, then feel free to connect with us at thetradespeakeasy.com. We have lots of options education where we are sharing how to utilize some of those option strategies to income generate against our long holds. And for those that maybe don't feel confident enough in their charting and feel like they're unsure about where something, a direction that an underlying is moving, then, get in the chat. We'd love to help you out to, send me a DM and, let's look at your chart. Let's look at what you're looking at. Let's see, are buyers coming in? Are there demand zones? Is there too much supply in the market? Whatever it may be, like, we can analyze that information together because the information is there. And it just takes a bit of time sometimes to organize the data. But I want all of us to be successful and for our portfolios to continue to grow. And sometimes that's not going to happen by just averaging down. Sometimes that means that we need to utilize new strategies like selling against our positions and expand or diversify accounts by investing in areas that might not have been as popular 1 or 2 years ago. So thank you guys so much for your time. And please like us here, like us on YouTube, share this video, and hope to see you guys again in the next live chat. Bye for now.